Welcome to Listen to the Market Q&A for February 1718. Before I get into the formal Q&A part, I'd like to share with you some ideas in relation to the effect of changing the exit rule, the effect it can have on changing the outcome of a trading approach. The chart down the bottom is what's called an equity chart that was sent to me by a L.I.V.E.T student, and he was playing with 15-minute bars, applying the L.I.V.E.T rule set. Very simply, no top-down approach, 15-minute bars, optimal time frame, taking the L.I.V.E.T setups and simply exiting as a trailing stop loss on the way through. Now 150 events equates to around 5 weeks of data. That's about a month of price activity. The equity line shows that it was started from 0, as they do, and ended up at around the 22 level. Now what do these numbers refer to? What do these numbers mean? Those numbers refer to the R value. Now the R value, R for Robert, simply is the percent of your account that you're prepared to play with for each campaign. So if your R value was 1%, after the 150 events, the R value stood at 22R, 1% of the account, 22% of the account. If your R value was 2%, then simply it would be standing at 44% increase on the account. Let's not get carried away with that. Let's have a look at the next page, which shows you the effect of getting out before the trail, getting out on period 1 versus period 2 versus period 3 of the campaign. Now, one of the most brutal tests that you can apply to a set of trading rules that purports to believe that timing is the key is seeing how profitable it is getting out on the close of the period of entry. So this graph here, equity graph on the left, shows that had you taken the setups as per the L.I.V.E.T rules but got out on the same period as you got in, 15-minute bar, started at 0 and ended up just under 14R for the sample period of 1 month. Stretching it out a little bit further, exiting on period 2, increased the return to just under 30R, and getting out at period 3 just over 30R. So what we're seeing here is by changing the exit rule from a straight trail, you're improving the overall profitability, and you're also improving the drawdowns themselves. Now the way you can see that is a factor called a recovery factor that simply looks to see what is your return as a function of the drawdown. The larger the figure, the greater the recovery out of a drawdown, which means that the drawdown is smaller in relation to the end result. The worst one was the trail, 2.65. The best one was 5.73. What is interesting also and valuable is the fact that in the sample of 150 events, 150 trades, there are only 9 1R stop outs. So less than 10% of the time does your full risk quota of 1R get hit. So kind of neat. So that gives you an idea, guys, of by changing the exit rule, you can change the outcome. Similarly, by changing the entry rule, which I'll share with you another time, you can also change the outcome. It's all part of putting together a rule-based, robust trading approach or robust system. Now on to the questions. First question was regarding Rule 101. And Rule 101 simply states that never let a winning campaign turn into a losing one. So the question is, if the original campaign is at break even, would adding to a position violate Rule 101? So an example from last week, we had the selling setup here on the 30-minute bar. Entry was achieved. 2 bars later, the stop was lowered from the initial down to essentially a break even, and there was another selling setup, being an RTV sell. Question is, the original position of break even now, taking aboard another 1R risk, is that violating the Rule 101? Well, if the market turns down and doesn't stop you out of your original position, all sweet. But what happens if the market does turn down and then reverses straight back up again and stops you at a break even on your first one and a 1R loss on the second one? You've actually turned a winning campaign or a break even one into a losing one. So yes, that would be violating Rule 101. There were plenty of opportunities down the track to add to a position where you had plenty of fat in that short campaign that 1 hour loss would not have given it all back. So hasten slowly, my friend. Next question, what is a GORB and a S3D? That was in relation to the top that the L.I.V.E.T setup speak rather well. Unfortunately, in deference to the L.I.V.E students who have ventured to Vanuatu to spend the 10 days with me to come on the program, and also those guys who've done it over the internet, I need to be a little bit circumspect with my answer. In other words, I can't give away their secrets. The S3D, as you know by now, 3D, three-dimensional, implies looking at more than one market than the one you're trading. An S3D is a reversal setup. Likewise, the GORB is a reversal setup. So there were two reversal setups, and unfortunately, I can't really honestly share the details with you at this stage. Okay, next question. There was a promise of higher highs on the previous bar before the sell setup. Yes, there was. The white bar was a promise of higher highs. The black bar that presented the GORB sell setup was in fact a higher high than the high of the promise bar. That promise of higher highs was fulfilled. The thing to bear in mind is that a promise of higher highs does not promise how much higher the market will go. It just promises that it will go higher. So all bets were off in relation to that promise still being in force on the bar after. Likewise, on the 15-minute chart, 15-minute view, 15-minute view was a promise of higher highs on the following bar. That was also fulfilled, so all bets were off in terms of the market was not saying that it still wants to go higher. So the promise, until it's fulfilled, is valid. Once it's fulfilled by 1 pip, it's all over, Red Rover. Okay, next question was to do with, on the 4-minute mark on the video, there's a buy setup. Yes, there is. There's an RTV buy. Now we just wait and manage. Well, it's an RTV buy. You're already long. Another buy setup there, RTV buy. Rule 101 says not enough fat in that long campaign to take an additional risk. Sit back and wait. How many and which levels should be monitored? This is referring to lines on the chart. As you are aware, the two lines that I always have on the chart is the previous day's low, previous day's high. When the market dictates that another level should be monitored, another spike low or another valid spike high, so be it. Only then do I put those lines on the chart. So the fewer the better, and dictated by the market itself. Okay, final question we have here is spot the difference. Two charts, two markets, both presenting an RTV sell according to the rule set, the black and white rule set. But there is a very subtle difference, and this is sort of marks the difference between knowing the rules and having internalized the setup and the rules themselves. So let's have a look at the parallels first of all, the similarities. Both markets embark on a movement up from a VSL, which in L.I.V.E.T speak is a valid spike low, and that movement up finishes with a valid spike high. The movement in between is referred to as a fluid movement up. This is pure L.I.V.E.T speak. Shows you the language and the concepts that L.I.V.E applies is not generally known out there in terms of the trading population. The fluid movement up marked the high in both markets. Both markets saw the price come down. Obvious difference is white bar there, black bar there. That is not the difference that makes the difference. Market then moves down in both cases, makes a new valid spike low. So we have a little fluid movement down there, and this third bar, last bar in both examples completes the RTV rule set. However, there is a major difference. The market on the right conforms to the idealized sequence according to the L.I.V.E.T concept of setups at a market top. The first requirement was or is for a reversal setup to appear and then to be followed by an RT or an RTB. No such event in the market on the left. Let's have a look at the outcome. Both markets come down, trigger the selling points. ISL is not hit. Both markets have lower highs, lower lows, larger ranges to the downside, formally promises of lower lows. The non-ideal RTV sell market rallied all the way back up, finished pretty much unchanged on the close of the previous period. Get out. No need to wait to be stopped out. This one, lower high, lower your stop. Let's see what happened next. Sure enough, this one was stopped out. This one, the move down, kept on going. So what I'm driving at is, yes, they are black and white rules. Yes, internalizing them and really understanding what they're based on can make a marked difference in terms of your bottom line return. So that does me for this week's edition of Q&A. Keep them coming. The more that you bring up, the more I can give you back in return, and let's enjoy this two-way boulevard. Thank you guys. Over and out.